get into the 42 macro risk management process. As you guys know, the number one thing we do for our clients here at 42 macro is to help you identify and position for the market regime. We don't help you identify and fight the market regime. Please don't fight the market regime. I'd rather you stop investing altogether than fight the market regime. There's nothing, in my opinion, I know one of the dumbest things human beings do is fight the market. The market is smarter than you. The market is the collection of all the smart people with all their money in the world. And if you think you're smarter than them, that's an incredible amount of hubris. I couldn't even have a drink with you at a bar if you had that kind of hubris. If you're going to fight the market, you know what I mean? You seem like if you're fighting the market on a regular basis, you sound like an insufferable person. So, and I don't think any of our clients are fighting the market, because you probably wouldn't be clients of 42 Macro, because we religiously believe that the market is smarter than us. So we help you identify and position for the market regime. We identify the market regime with our global macro risk matrix, and then we filter those market regime signals to retail investors via KISS and to institutional investors via Dr. Mo. And then everything else we say in this presentation, and anytime I open my mouth, everything else I say is with the goal of helping you understand the full distribution of probable economic outcomes, not so that you can do something with that information in your portfolio. We're communicating all that information to you so that when the market decides it wants to go from pricing in right tail risk to left tail risk, or when it decides it wants to go from pricing in left tail risk to right tail risk, you understand why, and you can dispassionately execute the pivot in your portfolio. If I only talked about bullish things, we're obviously fundamentally bullish. The markets are telling me to be fundamentally bullish. Our research process is telling me to be fundamentally bullish. But what if I never talked about anything bearish? Then the market regime suddenly transitioned to bearish. We'd all be confused and be like, well, should I execute this KISS pivot? It's telling me to take cash, but Gary's been super bullish the whole time. That's why we do fundamental research, is so that you understand the full distribution of outcomes, so that when the Mr. or Mrs. market decides, whenever it decides it wants to go from pricing in right or left tail risk to left or right tail risk, you feel comfortable enough to dispassionately execute the signal. That's all we're doing here. And I think it's a quite an effective mousetrap, as many of you guys have experienced in your own portfolios over the last few years. The Fed's own inflation forecasts project nearly 7 consecutive years of missing its arbitrary 2% inflation target. Again, this is their core PC inflation forecast. In 2027, they still don't have it getting to 2%. We've been above 2% since mid 2021. And they're not even going to get there by the end of 2027. Come on. What's going on here? You guys know I've had several conniptions on this program regarding the Fed's 2% inflation target. I don't, there's a central banker in New Zealand gave it to them, and they took it and ran with it, and now they're stuck with it. I think they should get unstuck with it. When you have the debt problem that we have, you have three options. You can cut fiscal austerity, you can grow very fast, or you can print. We know they don't have any political will in DC to cut. Elon Musk was on a chainsaw last fall talking about cutting $2 trillion. Guy left with $175 billion. There's no political will to cut, so now they're on the option two, which is try to grow. You're not going to grow your way out of this problem with a 2% inflation target. You're going to have to take that thing up. Let's crank this thing in a high gear. Powell's not going to do it, but I'm guessing the next person is going to consider it. Maybe they won't do it. Maybe they'll implicitly do it. I don't know how they're going to get around this, but the Fed is going to be more comfortable as we go forward in time with higher inflation. They're already signaling to you that they're comfortable with higher inflation. They're not going to hit their 2% inflation target for almost 7 years. So what's another 50 basis points of inflation? So our secular inflation model since the beginning of 2022 has said the equilibrium level of core PC inflation, which would be this horizontal line here, somewhere around high twos, low threes. It's currently in the high twos, low threes. If this is the amount of inflation the economy is just naturally going to produce, then having a 2% inflation target means the Fed is going to be more restrictive than it otherwise needs to be, or less accommodative than it otherwise needs to be, certainly for an administration that has a clear and stated objective to boom the economy in a way that stabilizes the debt to GDP ratio. Work backwards from there. Don't work forward from, I have a lot of respect for Nick Tiramos over at the Wall Street Journal. He works forward from the current state and the current people on the FOMC are feeding him to tell the public. I'm working backwards from where we're headed and coming back. these institutions, we're in a fourth turning. Fourth turnings are where institutions go to die. Fed independence could die in the fourth turn. The Fed could die. This country could die. That's what happens in fourth turnings. You gotta assume that the very narrow range of outcomes that we're used to as investors and economic agents is just significantly wider now. And so, I probably sound like a heretic or a lunatic talking about a 3% inflation target, but guess what? In 3 to 5 years, I won't. I guarantee you I won't, because that'll be one of the only levers they can pull to deal with this ridiculous debt situation that we have. That, by the way, is continuing to compound at ridiculous levels. So I think we've done as much research on understanding foreturning economic and fiscal monetary policy and geopolitical dynamics as anyone. So I feel very confident when I turn on the TV and I listen to folks like Paul Tudor Jones and Ray Dalio and Jeff Gundlach saying a lot of the same stuff that I've been saying for years. I think I'm onto something here. And when I listen to Stan Druckenmiller, these are some of the best investors in the world in history. All of them in the top 5 to 10 investors in history. When they're saying things that I've been telling you guys for years, I think I'm onto something here. Which means the consensus regarding the outlook for Fed policy over the long term is just wrong. It's mispriced. And so I think that's a significant right tail risk for asset markets. Here's why. Well, here's one of the reasons why. And I'm just going to read this from Truth Social. President Trump posted this on Friday. Too late Powell complains about costs. Actually, let me do it in the Donald voice. Too late Powell complains about costs, much of which were produced by the Biden fake government. But he could do the biggest and best job for our country by helping to lower interest rates. If he reduced them to the number they should be, 1 to 2%, that numbskull would be saving the United States of America up to $1 trillion per year. I fully understand that my strong criticism of him makes it more difficult for him to do his job or do what he should be doing, lowering rates. But I've tried all the different ways. I've been nice, I've been neutral, I've been nasty, and nice and neutral didn't work. He's a dumb guy and an obvious Trump hater who should have never been there. I listened to someone that I shouldn't have listened to, and Biden shouldn't have reappointed him. We have virtually no inflation. Our economy is doing really well and will soon be doing with the tremendous tariffs income coming in and factories being built all over the country better than it has ever done before. If he was concerned about inflation or anything else, then all he has to do is bring the rate down so we can benefit on interest costs and raise it in the future when and if these other elements happen, which I doubt they will. Don't say that you think there will be inflation sometime in the future, because there isn't now, but there is. If there is, raise the rates. We should be at the top of the attached list, not the bottom. He had a post of a bunch of countries' interest rates sorted in reverse order. So the lower rates were at the top. I don't know why the board doesn't override this total and complete moron. Maybe, just maybe, I'll have to change my mind about firing him. But regardless, his term ends shortly. This is the president of the United States, a guy who has been convicted of several crimes, who has no problem at all rewriting the rules of law and rewriting institutions to get what he wants done. He's demonstrated that on many occasions already in this second term. Do you think this guy cares about, the Humphrey Hawkins statute? He doesn't care. He wants lower rates. So just work your way backwards from the outcome. Don't worry about the legal roadblocks between now and the outcome. Just think about the outcome and go, this man who survived a gunshot wants lower rates and he wants to engineer an economic boom. So just assume that it's going to happen. Don't assume that it's not going to happen, because right now the market is assuming that it's not going to happen. And the risk in financial markets is that it does happen. That's what I'm trying to communicate. The probability of nothing happening is already priced, but the probability of something happening is not priced. And that is where the risk is. That is right tail risk that you need to be aware of as investors. So let's keep moving. The power replacement trade is gaining steam in US dollar money markets. So this is the June 26 SOFR yield minus the March 2026 SOFR yield. So you can see the markets are already starting to bet that, hey, whoever comes in at Fed is going to immediately start lowering the interest rate. But in our opinion, this 21 basis point spread could easily go to 50. Why is it not 50? Why is it not 100? I mean, 1 to 2%. We're at 4.5% now. He literally truthed, sorry, posted 1 to 2% yesterday. The Fed doesn't, the president doesn't set monetary policy, but the president does appoint people to the Federal Reserve Board. And this president, with perhaps the help of a Republican Congress, might decide to change how the Fed operates. We're in fourth turning. You have to assume the range of possible outcomes is historically wide. That's what happens in fourth turnings. If you're thinking like normal, Mr. Nick Tiramos, our friend Nick Tiramos, if you're thinking like everything's just going to operate in this narrow range of outcomes, then you're not going to be a good investor in a fourth turning. Sorry, it's true. So keep moving here. In our view, U.S. dollar money markets are not fully pricing in the risk of Jay Powell being replaced by a dovish sycophant. So again, if you look at the floor Fed funds rate, that's 3.26%, so 3.25. Why is that not 250 or two? I mean, he just said 1 to 2. Why is the floor Fed funds rate, which is the lowest, the minimum value on the OIS curve out 2 years? I think you got to slash that by at least 75 basis points. It's going to 250, folks. It's going to 250. They want lower interest rates. They need lower interest rates. So work backwards from there. And if I'm wrong about all this, then guess what? It's already priced. Again, it's already priced that nothing is going to happen. So who cares if I'm wrong? But what happens if I'm right? There's the rub.